Good morning, everyone. I'm delighted you could join us today for our webinar on sustainability and reward. And I'll explain a bit about what that means over the next couple of minutes, and I'll introduce our speakers. Thankfully, we're joined by some experts, so it won't be me doing all the talking. Laura Wadding is my name. I'm a partner here in Risk Advisory in Deloitte, and I lead our sustainability market offering. And that means lots of different things. And I guess when I think about the sustainability in the broader sense, it throws up a number of words to me, such as the fact that it's non-linear. There's no straight path to success when we talk about sustainability. It's pervasive, so it's currently everywhere. It's every turn of the head brings about something new in the area of sustainability and climate change at the moment. And I'm sure you will all have seen that in your personal lives and in your professional lives. And it's pretty complex. There's a lot of regulation that is evolving, in particular for financial services and for corporates of a certain size. And there's a huge impact in the investment management sector. There's going to be mandatory reporting and assurance that will need to be performed, from 2023 onwards for a lot of entities and a lot of our clients. And technically it's complex, plus there are some challenges around access to data and things like that would feed into the reporting. So it's a really big topic, and I guess it's hard to distill that down sometimes, and what we hope to do today is just touch on what ESG means to us, and then talk about it in the context of reward, and also in the context of the board, the role of the board and governance and the board's oversight. So maybe just to think about what we mean when we say ESG, and I've gotten to the point where I can say things like, it fundamentally means making good decisions. It's obviously a lot more complex than that, but I hear firms coining the phrase that we want to do good while we're doing well, and I think that that probably sums it up for me. So it's not an anti-profit movement. It certainly is something that is intended to drive profitability, but it's also intended to drive the doing of good, which means from an E perspective, that's primarily around, protecting the climate and the environment, and ensuring that an organisation doesn't do any further damage, really, and helps in the movement towards that net zero, the race to net zero, and alignment with the Paris Agreement. And then you've got the social side of things, which really is what a lot of firms would have covered in their corporate social responsibility policies for many years. And then you've got governance, and there isn't a zero-sum game. So you can get one right, and that can actually have a knock-on effect on another part of it. And I think most recently, some examples that I saw this week were on the news yesterday. There was a dull debate about the rising cost of fossil fuels in Ireland, of energy in Ireland, and the inability of some people to pay their electricity bills as a result, or their gas bills. And the price of fuel is rising because of carbon tax, because it's seen as a good thing to reduce carbon emissions and to get rid of fossil fuels altogether. But in the meantime, it's impacting the more vulnerable parts of our society. And so we're doing good on the environmental side, but we're doing something bad on the social side. So a lot of what we talk about when we refer to ESG is about balance, and there's a lot of judgment that needs to be used, and it really is about good decision making. So with that in mind, today's webinar, we're going to focus on the reward element of sustainability, and the performance management side of things, and how ESG risk criteria might be factored into the reward discussion with employees. And thankfully, we're joined by Anne Kelleher and Rhys Thomas, who are going to give us the benefit of their expertise this morning. They both specialise in remuneration practices, and they're part of our tax and legal division in Deloitte. And we're also joined by Melissa Scully, who specialises in governance and sustainability, and she's going to give us a view on what this means for the board and their role, their fiduciary responsibility and their oversight. And so with that, a couple of housekeeping bits. We have a couple of Menti questions. So if you have your phone to hand, we'll give you the details to log into Menti and answer some questions as we go through the presentation. And we're going to try and keep some time at the end for Q&A as well. You can put Q&A, you can put questions into the chat functionality and go to webinar, and I'll pick them up as we go. I'll be keeping an eye on them. We'll try and get to those towards the end, and we'll also be circulating the content after the webinar as well. So with that, I'm going to hand over to Anne, who will present to all of us on the reward considerations within ESG. Thanks, Anne.
Laura, thanks for that great introduction, and good morning to everybody, and it is lovely to meet you virtually. Hopefully there's a time we'll all be face to face very soon. Rebecca, if you can go to the next slide, that would be great, please. Over the next about 20 minutes, we will talk to you about what ESG means in a reward context, look at some of the current trends in relation to ESG, and what are the proxy advisors saying around ESG. Reese, my colleague, will then pick up on ESG in incentive plans, and especially talk about bonuses and long-term incentive plans. Next slide, please. I think it's fair to say that we all would agree that the corporate governance and ESG has altered dramatically over the last few years, the landscape in relation to those items. And we have seen an increase in ESG regulation measures proposed globally. Laura also mentioned this, especially in the financial services and also in relation to corporations of certain sizes. However, as businesses try to focus on building a stronger ESG performance into their structure and the culture, one way to do this is by linking ESG targets with executive remuneration, and indeed with remuneration for the wider workforce, and I'll talk about that shortly. ESG is important, obviously from an increased value in the company perspective, but also in linking ESG to rewards, it can also help support the balance of excessive focus on short-term performance targets in typical remuneration packages, which is contrary to the long-term financial and sustainability objectives. And also it can create greater accountability on sustainable performance at all levels in the organization, and especially at leadership level, to role model and lead the way. I think it's important before companies, link ESG to executive remuneration, or indeed wider remuneration, is that they ask themselves some questions, especially in relation to the targets. So with financial and personal metrics in annual and long-term incentive schemes, the key to implementing ESG measures is to ensure that they incentivize the right behavior. And this can be achieved if it's structured correctly, and also if you use the right quantifiable performance targets. Are your targets achievable? Have they a stretch goal in them? And also to make sure that they're targets that stakeholders can get on board with. We're also seeing third-party verification of such targets. One of the most important points I would call out is that in setting targets, or indeed metrics in relation to ESG for executive remuneration, is that they align with the overall strategic goals of the organization. And what do I mean by that? Ideally, I think companies should have an overarching sustainable strategy. They should have metrics that are already being tracked. And then I think as you link them to rewards, if you can adopt those ones that are already being tracked and tested by the company, that often leads to the best success. And I think to Laura's point that this is a vast subject, it's a subject that's evolving over time. What we are seeing with clients is that when it comes to ESG and linking it to executive remuneration, that in fact it's a collaboration between risk advisory, finance, and remuneration specialists dealing with remuneration committees, the board, and indeed senior people in the company. And also this is obviously evolving over time. Next slide, please, Rebecca. So I think we'll take our first meaty question. And if you have your phones ready, etc. Has your organization introduced ESG metrics into your organization executive remuneration? Just very high level to kind of see what the appetite is out there. We either have, we intend to, or we have not. So if you could place your answers now, please. You should see it coming up on the screen. We'll give it a few more seconds, and if people can respond, we'll come back to it. So we have one person who says we have. So perhaps we'll come back to it. So if we move on to the next slide. All right. As we look at the key focus areas in relation to ESG, climate change and the road to net zero is very topical at the moment. And I suppose this is especially as companies and countries come together under the 26th EU Climate Change Conference. As governments across the globe introduce more climate-related regulation, we are expecting to see an increased commitment to net zero emissions by companies and investors to become standard practice by the end of the decade. So as more firms will look to seize opportunity in this area and position themselves as climate leaders, on the other hand, we're seeing that investors will increase the engagements around climate change and will likely begin to incorporate climate risk into their voting practices. In the last year, we have seen an increase in the use of ESG metrics linked to climate, in particular under long-term incentive plans. Over 50% of ESG measures included in long-term incentive plans are related to climate-related goals. So that would just show you, even in the last 12 to 18 months, the focus that climate change has in relation to ESG metrics and executive remuneration. Science-based targets are often favoured by investors as they allow the businesses to demonstrate the net zero goals that are aligned with the Paris Agreement and the latest climate science. So it can be, I suppose, more rigor and tested from a measurement perspective. One of the other areas that I would like to draw attention to is around disclosure, and disclosure on ESG factors will become standardised and widespread by the end of the decade. And this will mainly be driven by regulation and also by investors. In relation to executive remuneration, where we can see this coming through is on, corporate governance and stewardship codes around disclosures on executive remuneration, say for fair pay, and also around diversity and inclusion. When we look at diversity and inclusion, we're seeing that companies are actually focusing diversity and inclusion beyond the board. They're looking at the wider workforce, and where boards and remuneration committees may not be responsible for the actual reward of all their organisation, they're very conscious of how that's delivered in the broader organisation when they're setting remuneration policies at the executive level. And we're seeing that the diversity and inclusion on the workforce is very topical. And Rhys, my colleague, will talk about gender pay legislation in Ireland and how that can be used as a strategic tool that can aid and support companies. Also, I believe that executive remuneration will be reviewed and potentially changed so that it's building in longer-term sustainability in the next few years. Next slide, please, Rebecca. Just to pull out some examples, and I'll talk about two examples from a company perspective where they've actually introduced long-term sustainability into their reward practices. So Ryanair, in their annual report this year, have indicated that they have introduced the ESG metrics around CO2 emissions, which aligns to their strategy in their long-term incentive plan, and the weighting is about 20%. Typically in the marketplace, what we're seeing is that the weighting of ESG metrics in incentive programs is no more than about 20 to 25%. Lynn, the investment advisor, has advised that they wouldn't like to see ESG metrics as being more than about a third of the overall performance weighting. And I think Ryanair, having introduced it for the first time this year, it's good to see. Vodafone also, to support their ESG strategy, have built a purpose pillar over three main topics so that they can separate out their ESG metrics. And I just reference one under their inclusion pillar. They have indicated that by 2030, that 40% of their senior positions will be held by women. So it just shows you how different companies are picking different metrics and targets to align to what's meaningful for their company's sustainability strategy, and picking the right metrics and targets for their company. Just a reference to Kingspan as well, they've also introduced an additional ESG metrics that aligns to their passionate around the planet and improving their overall sustainability and environment in their performance share plan. And that weighting is about 10%. So it shows you how companies are varying. Next slide, please. Just kind of to touch on a small point here. Obviously, from an investment proxy perspective, they are also, because of the focus on ESG and sustainability, because of the focus on now linking ESG metrics into both long-term and short-term incentive plans for companies. Investment advisors are now giving, using, I suppose, their power to give, analytical and data-driven kind of scoring to companies and how they're disclosing, how companies are disclosing their ESG metrics. And I think for a lot of companies, are indeed boards and directors levels who are starting the conversation around ESG metrics and how to build it into company rewards programs, their guidance should be looked at and taken as one tool to support those discussions. They would very much focus on transparency. So in setting those ESG metrics and targets, what are companies currently disclosing in their financial filing that portrays what they're doing in practice around ESG and what their philosophy is in that regard. Also, companies should really look to understand what's very meaningful for them within ESG on the different E, the S and the G focus areas, and how their stakeholders are going to view it, not just today, but also in the future, so that you're looking ahead at how this evolves and what this could mean for your company performance. So it is a lot of information, and I think getting support either through, reference to the proxy advisors, getting specialist report on risk and also reward on how to bring this all together is very important at board and director level. Obviously, the ISS indicated that, as remuneration committees were making decisions around executive remuneration, they should disclose how they measured ESG in that context and how they took it into consideration. And that was earlier this year. So you can see, even from an investment proxy perspective, their thoughts and their focus on this is evolving as well as it is at a company level. And definitely in the future, I think we will see more consistency and more long-term and short-term incentive plans being very particular in relation to what ESG metrics they pick in order to ensure that there is sustainable performance in a company and also that leadership is held accountable for same. Maybe if we go to the next slide, maybe we'll try another question, and if not, I'll move on to Reese. For organizations who've considered introducing ESG metrics into their incentive plans, how have they been introduced into annual bonus, long-term incentive bonus, or both? And then Reese will talk about what the market data is saying in that regard. So maybe we'll just give it a few minutes. Interesting, just to say as we're waiting for this, that if I flick back to the first question that we asked, that companies are thinking about how they're including ESG into rewards, and yes, that will be an evolving topic over time. So where the responses are quite low at the moment, we are seeing that long-term incentives are being considered for ESG metrics to be included, which is very good, and targets. Reese, I'll hand over to you.
Thanks, Anne. Within the context of Irish PLCs, 46% of participants in a recent Deloitte survey indicated they've included some form of ESG metric in their incentive plans, with sort of social metrics being the most commonly included. We also see further afield that ESG metrics are predominantly included in annual bonus schemes within the FTSE 100 and 250. Following this trend then, 70% of the largest European companies now include some form of ESG metrics within their incentives as well, again with social metrics being the sort of most common, although we are seeing an increase in both environmental and governance metrics as well. In terms of types of metrics used within the Irish PLC environment, then again, social metrics related to employees, customers, or diversity and inclusion are the most common within the sort of annual bonus schemes. Whereas what we see is the environmental metrics are more commonly included within the LTIPs, probably reflecting the sort of long-term nature of environmental targets. And overall, the Irish trends tend to be in line with the momentum we're seeing across Europe. Looking at ESG metrics, it's not only the large PLCs that have had a spotlight on them recently by investors. A recent survey by City AM has reported that investors expect sort of greater focus on ESG issues in the small and micro cap companies within the UK as well, with 87% of investment managers surveyed stating that they believe the focus on ESG will increase over the next 12 months or so. When choosing ESG metrics and which ones are correct for your organization, it's helpful to look at what the proxy advisors are looking at in this. And what they tend to be saying is that they expect measures to be quantifiable, relevant to the business, and ultimately in line with the company's strategies. And then looking at companies, I suppose, outside of the PLC market and maybe the ones who are looking at sort of IPOing at the moment, there's another interesting article in CDAM on Tuesday, I think it was, that said that companies looking to IPO at the moment, there's quite a large expectation on ESG with them. And to put simply, ESG drives growth, and firms that have a sustainable agenda now will be the winners in the future. I think this has a greater focus ahead of the UN 26 climate change conference as well. Moving on now, we'll look at some of the key considerations, including ESG metrics and incentive schemes. Here we see the type of metrics applied across the three headings. Environmental metrics include sort of water efficiency, flight emissions, and CDP, a carbon disclosure rating, which is to measure environmental sustainability of a company, administered by the CDP organisation in the UK. We more commonly see environmental metrics in the LTIPs, and it's definitely an area of sort of emerging focus in investor groups and indeed the proxy advisors as well. Social metrics then can include sort of diversity and inclusion, which I'll speak a bit more on later, implementing the living wage and digital education. We're seeing some increased focus post-COVID on these social metrics, which I suppose aligns with the broader conversations in society around equality and sort of corporate social responsibilities of companies. Looking at governance metrics then, we largely see these in financial services organizations, and they usually include some sort of element of risk management, cyber data security, and regulatory relationships. And when we look at these, we see a sort of natural alignment of these metrics with the wider regulatory environment in financial services, such as sort of the CRD5 for banks and the Solvency II regulations for insurance companies. I know Anne mentioned a few examples earlier on, but I suppose just to give an example of what we've seen for another company as well on the sort of three headings. If we look at Diageo, they've sort of implemented 4 goals reflecting Diageo's vision to make a positive impact on the environment and society. And these sort of metrics and goals include carbon reduction, water efficiency, education on the dangers of underage drinking, and diversity and inclusion. Looking at how to include ESG metrics in incentive plans, then there's a number of ways, as we see at the bottom of this page. These range from underpinning an incentive scheme with the inclusion of specific ESG related metrics to the other extreme of sort of having a standalone incentive plan based solely on ESG goals. The most common approach adopted by the majority of organizations would be the basket or scorecard approach, which typically involves choosing 4 to 5 ESG related KPIs assessed as part of the scorecard. Moving on to the next slide then, we can see that sort of climate change, and as I think it's been addressed by Anne earlier on, is a sort of very heightened element at the moment. It's sort of an area of fundamental importance within modern society. And we're very much seeing this being reflected in the thoughts and initiatives from remuneration committees. Remco is beginning to introduce climate change metrics into their incentive schemes, and these metrics will reflect shareholder sentiment, investor guidance, and I suppose the wider societal views on what organisations should be contributing to the fight against climate change. And now I'll just close out our section with a brief comment on gender pay gap reporting in Ireland. The Irish government passed the Gender Pay Information Act in 2021 in July of this year, and it's been a fairly long road to it, but the mandatory reporting of gender pay statistics for Irish companies has now been mooted sort of for several years, and we expect to see the first round of reporting taking place in late 2022. Although the government haven't published the exact regulations yet, we sort of expect a fairly similar regime to what's seen in the United Kingdom since 2017, with some additional elements such as the reporting of ratios and men and women receiving BIK, along with some sort of additional reporting elements around temporary and part-time workers. And with the impending, I suppose, mandatory reporting regime coming down the line, it seems likely that organisations may wish to consider including gender pay metrics in some form in their incentive plans as part of an ESG metric. This will reinforce the message that organisations take this gender pay gap seriously and something that should be incentivised to be reduced and eventually eliminated where possible. Indeed, we've seen this in a number of organisations in the UK where specific metrics around the lowering of the gender pay gap and achievement of the organisation's DE&I strategies have been included in executive incentive schemes. And again, they've mostly been sort of included as part of that scorecard or basket approach as discussed in the previous pages. So thank you for your time. This concludes our sort of ESG and rewards section of the webinar. I'll now pass you over to Melissa, who will talk about ESG and governance.
Great, thank you, Reece. So building on from Anne and Reece's presentation, which covered some of the key trends in ESG and reward, I'm now going to look at 3 key areas to build on that. So firstly, the role of the board and the Remuneration Committee in respect of ESG and looking at it in particular with the rewards slant. Then I'm going to cover some of the key challenges and almost the watch outs for both the board and Remuneration Committee. And then lastly, I'll share some practical tips and guidance to have a think about for the year ahead. So firstly, looking at the role of the board, whenever we talk about the role of the board, I always summarise it as 3 key responsibilities. So stepping back and looking at that role more broadly, so the first responsibility is all around stewardship. So that's actively shaping, supporting the future and strategic direction of the business. Alongside that, then you've got the second responsibility, which is supervising. And this is the area that we see a lot of boards currently spend most time on, and is all around looking after its legal and fiduciary responsibilities, and in particular holding management to account. And then lastly, the third key role of the board is all in respect of accountability and being accountable to its key stakeholders. Looking at each of those through the lens of ESG and reward, what I would say firstly in respect of stewardship is that ultimately it's up to the board to make sure that the organisation has a clear purpose and that within that purpose its ESG goals and ambitions are clear and aligned. And then alongside that, as Anne mentioned earlier, it's important that there is an ESG strategy, and that's effectively built into the overarching strategy. So what we mean by that is that the company strategy should think about each of those ESG components within it. It's also important that the board is making sure that the company has the right culture to really foster and pursue those ESG goals and ambitions, and looking at it from a long-term sustainability perspective. And the board also plays an important role when it comes to shaping not only the strategy but the governance structure to ensure that there is effective oversight. From a supervisory perspective, and this is again, as I mentioned, an area that the board is often most familiar with, and this is where the board will be predominantly holding management to account for the implementation of both the ESG strategy and the specific targets. I think importantly, and an area we've seen quite a lot of work across organisations in the past 18 to 24 months, is all around the risk framework and making sure that it's effectively identifying the relevant ESG risks and ensuring that there's proper mitigating action, and that it's looking at ESG, both risks and opportunities, holistically. And then, as I'll come on to later, then a key area for the REMCO is to make sure that as part of its supervisory role, it's really challenging and holding management to account from a reward perspective and bringing that into account in terms of some of the key decisions they will be making in respect of pay. Lastly, in respect of accountability, I think this is really important when we think of the board's role in ESG. So the board needs to be very clear on who its key stakeholders are and what ESG matters are material to them. And we have seen recently a lot of work being undertaken in respect of stakeholder surveys and engagement to really understand those material issues and try and determine where the key focus is from a stakeholder perspective. The board then needs to make sure that it's getting the right information and messages from stakeholders so that it understands what management is communicating to the stakeholders, and also that the board itself is engaging appropriately with the stakeholders. So for example, the chair and the remuneration chair may engage with institutional investors, for example, in respect of ESG and the various metrics and reward criteria. And then lastly, when we talk about ESG and the various initiatives, I think it's important for the board to be thinking about it from an outcomes perspective. So how does the board know, as Laura mentioned earlier, that the organisation is actually doing good and its commitment is going beyond profits to the wider interests of society? So in that regard, it's important to be thinking about the outcomes and whether those are measurable, and if there can be any examples throughout the year where they can take case studies or indeed measure some of those initiatives. So moving on from the role of the board, just to delve a little bit deeper into the Remuneration Committee and some examples of where it will play a key role in looking at ESG and reward, and just to build on what some of the areas Anne has said. I think a key trend that we will see is focus not only on ESG metrics and executive pay, but also how some of those metrics translate into the wider workforce. And we have seen some examples, particularly in the listed company space, where some of those metrics, for example, around employee retention and D&I, particularly on the diversity targets, are being pushed down to the management levels below. Another area that the Remuneration Committee will need to have sufficient time and focus on is on its review of the remuneration policy, to actually look at whether that aligns with the ESG goals. And interestingly, when you review some of the FTSE 250 annual reports, you can see that there's quite a number of remuneration committees have already undertaken this exercise, but there's still quite a few who've yet to disclose how their remuneration policy links to their wider ESG strategy and initiatives. I think the Remuneration Committee can also play an important role in supporting the board in monitoring the culture. So I mentioned earlier that it's important that the board sets the culture and that it's aligned with the ESG and sustainability ambitions. But as part of looking at the assessment of the various reward metrics, how does that align with some of the softer culture metrics, and is the executive team delivering on the overall culture? Are they helping to create the right culture to achieve the ambitions? And if we move on to the next slide, please. So some of the key issues, and we've heard a little bit from the earlier presenters and some of the key challenges, but just to really draw the attention to them from a board perspective. I think one of the key challenges is firstly making sure that there's a clear rationale as to why some of the particular metrics have been chosen, whether that's for taking an annual bonus approach or for the longer term plans, but making sure that there is clear alignment to purpose. And when we talk about company purpose, it's ultimately what is the company there to do, and to what value is it creating for wider stakeholders. And we've seen a lot of press attention on this, and I think Larry Fink and his CEO letter also references, purpose is going beyond profit, and it's really important that from a reward perspective there is clear linkage between the company purpose and ESG reward metrics. Another challenge that I think is really relevant, and we can see this from the data that Reese presented, and it's really around how do you make sure that you're setting clear and measurable stretching targets. So it is quite a minefield to look at ESG issues and to determine those which are the most meaningful for the company. But looking at that further to see, okay, well, are we really stretching ourselves, particularly on the longer term incentives? And then another challenge associated with that is looking at the balance between financial and non-financial criteria. So we have seen, and we've heard earlier, that I think D&I and health and safety are some of the key areas where we're seeing non-financial criteria being set, but it's about making sure that the right metrics for your industry are being selected. And so we are seeing more companies look at other metrics beyond those areas, such as product and social inclusion as well. So I think it's important that there is an appropriate balance there. And then the last key challenge is all around disclosure. So we have seen international convergence amongst standard setting to really bring some clearer guidance and standards around ESG metrics in annual reports. But my advice to boards and remuneration committees would be, you know, while that is being determined and emerging, I think the other key area boards can do is really look holistically at the messaging and disclosure in annual reports. So in terms of, you know, everything from the front end disclosure and the accounts and statements, to make sure that clear messaging is occurring throughout. And also importantly for the remuneration committee to really tell the story about the linkage between ESG strategy and rewards. And we have seen some good examples of that, which is available in our Deloitte annual reports insights, and I'll share a couple of examples now. So moving on, if we look at, just to call out a couple of examples, we've presented here on this slide Anglo American PLC, and this is just one example of good annual report disclosure, and you can see that in 2 pages it's clearly set out its purpose and its key strategic elements, and then along that it's set out how it measures the delivery of the strategy, and you can see there that they've clearly built in some ESG components in respect of that, and they've also then set out some specific information on this upfront slide about how they balance then the reward against that. And then another example moving on is from One Savings Bank PLC, and it's an example of a balanced scorecard in remuneration disclosures which sets out the key metrics. And you can see clearly here that they have their financial metrics and they've set out the weighting to them, but they've also included some wider non-financial metrics. I think one other point I would just highlight around the disclosures, which is quite interesting, is that we are seeing that a lot of the disclosures it's backward looking, and where companies have indicated forward looking areas in respect of reward ESG metrics, they've tended to be broader themes rather than specific KPIs, and with that they've referenced that due to commercial sensitivities they can't provide the information at that point in time. So I think that will be an interesting development to see how that evolves over the next 12 months and whether we see more pressure from proxy advisors and investors to have more forward-looking information. So then just to wrap up on my side, I will now just finish off with a few practical steps and things to think about going forward. So the first for boards and their committees, so not only the remuneration committee, I think this point is relevant to all board committees. I think now is a good time, if it hasn't been undertaken recently, to really look at the terms of reference or the charters to make sure that they're very clear on the responsibilities they hold with it from an ESG perspective, and that more importantly that that's been mapped out in the forward plan, so the board knows exactly when it's looking at certain areas, be it from a risk perspective and strategy or reward throughout the course of 12 months. And the second area and practical tip, and I mentioned this earlier, is in terms of engaging appropriately with the stakeholders. So if there isn't one already in place, I would suggest that you have a stakeholder map that sets out the key stakeholders, who's engaging with them, and the regularity of the reporting and information coming back to the board. We've also heard quite a bit throughout the duration of this session on metrics and targets. But I think just to reinforce that it's really important to make sure that those targets and metrics are being monitored continuously, and that the board and its committees is taking the appropriate time and the agenda to oversee them. And importantly also for boards, with support from the management team, to really look at the quality of the information that's being received, to think about the underlying processes Are they there? Is the data available? And also, not only from an internal perspective, but are you getting the comparable data from, be it industry or other sectors, to help both the board and its committees make informed decisions? And then lastly, and I think for those of you who are on the call, you're already demonstrating this, but training and development, I think, is really important. You know, there is so much change in this space and so much focus across multiple stakeholders, and both locally from an Irish and a wider EMEA and global perspective. I think it is important that there is specific time and training and development activities that covers some technical matters, but also brings that, you know, broader knowledge of trends and understanding of market focus. And really, again, this is all to support the board and its committees in discharging their responsibilities effectively. So on that note, that's a very brief overview building on the earlier presentation. I'll now welcome back our other speakers. I think we've kept to time, which is good. So Laura, I will hand over to you to see what questions we have coming in.
It's brilliant, Melissa. We might even finish ahead of time if we're really, really lucky. Thanks so much, Melissa, and thanks to Anne and Reese as well. I hope that some of the attendees, you know, got some good value out of that. And if there are any questions, please send them through the chat functionality. I have a couple that I have received that I wanted to raise. I might keep with you, Melissa, just for the moment. And obviously, you know, this is a huge area of interest across all sectors of society. And you know, in the boardroom, there's quite a diverse mix of experience and skills, and you know, depending on which sector. And you know, this as I said, is quite pervasive, right? So, you know, what's your view in terms of how boards are responding to that? Do you see boards recruiting new directors that have, you know, some specialist knowledge of ESG?
See, it's a good question, Laura, and it's one we're getting. It's coming up during a lot, particularly through board reviews. We're getting asked from a succession planning and review of board composition, do we need specific skills in this area? I think at the moment we're seeing two things. So we are seeing certain sectors look for specific sustainability expertise amongst non-executive directors, and this is in particular for some who are looking for a chair role that can, so an individual that can look after a sustainability type committee. But aside from that, interestingly, we're also seeing a trend towards this concept of all the board members having sufficient fluency in sustainability. So to me, that piece is almost more important. So there's certainly, you know, there is a need for all of the board to understand ESG and sustainability and to really think about it in every aspect of the board's decision making. Yeah.
And what's the best way for the board to get access to that insight and awareness?
Yeah, so I think there's leveraging internal capabilities, you know, so I think making sure that if there is a chief sustainability officer, or at least, you know, sustainability specialists in the firm, making sure that the board is getting access and updates from them. And then looking at its professional development, whether that's having specific briefing sessions or sending their directors on courses. So there's lots, as I'm sure we've all seen, so many professional and certifications and courses as well.
Yeah, okay, very good. And I know you provided lots of tips there as to, you know, how boards can get a handle on this in specific areas. The reporting and disclosures bit, like that's a really big area for many corporates and for financial institutions alike. Like, what would you say are the sort of practical tips that you would provide around that?
So you're right, Laura. It's such a huge area, and I think definitely with the regulation in this space, it's continuously moving. I think my key practical tip here would be to set aside the time and to really, what we tend to see is taking last year's annual report and disclosures and updating it, but I think now really is the time. And I've seen some companies I work with where they're actually, 12 months ahead. They're almost taking a blank page, and they're, really thinking about those key messages and alignment, and going back to the starting point. I think that would be my, carve out the time, get a working group of the relevant stakeholders, and really think about how what's the messaging, and what do you need to do to convey that.
Yeah. Thanks, Melissa. And Anne or Rhys, or both of you, question came in from the audience there. And we know, right, because of the breadth of our client base in Deloitte, that some sectors are hit more heavily with ESG principles and requirements. One question came up specifically around the construction industry. Do you have any insights as to how the construction industry are including ESG in the reward space, or in the reporting side of things? Do we have any examples of that?
Rhys, do you want me to take it?
Yeah, far away.
Okay, and come in then. I think the construction industry is a very interesting one, because I think from an ESG perspective, there's if you look at the nature of the company, there's a lot of focus on health and safety. And I think a lot of the companies in construction will be putting metrics and targets around the health and safety of their employees. And I referred earlier in my presentation around LIM giving guidance, and especially to companies of high risk, they would expect them to have within their incentive programs some metrics around health and safety. And if there's any fatality, which would be incredibly unfortunate, that they would expect that performance would be very much targeted, and that there would be consequences. So I think from a construction industry, that's one. Obviously a climate change as well, from construction and materials as well, we're seeing that. And interestingly, and I know Rebecca mentioned this as well as Rhys, around diversity and inclusion, that's an element that goes across all industries, and especially in industries which particularly may have been more male dominated, and especially with the gender pay gap reporting legislation, we're really seeing industries across all sectors really trying to understand how they will use that legislation and mandatory reporting to help them strategically in their company. Because one of my greatest beliefs is around the gender pay is, yes, it's an action that needs to be done. It's now going to be mandatory for companies to report, but companies can use it strategically. And if they get ahead of the curve and understand their data, they can very much align what they're seeing from the data and the mandatory reporting requirements to put action in place. So again, in summary, I would say from a construction industry perspective, it's a lot of focus around health and safety, also diversity and inclusion is what we're seeing. Rhys, would you like to add there?
Yeah, no, I think the only thing I'd add to that, Anne, is that I think I suppose the breakdown of the metrics follows what we're seeing elsewhere, in that I'd say that the majority of the companies at the moment sort of including an annual bonus, but there's also a move to include things like sort of environmental metrics in the LTIP plans.
Yeah, I think that's really interesting. I absolutely think that certain sectors, no sector is winning this outright. They all have different mountains to climb, and those mountains are not always the same. So I think that's going to be an interesting evolution as to how different sectors are handling this. We've seen different approaches being taken in the transport sector, in the financial sector versus the construction sector. So it's definitely not a one size fits all, and I think firms need to really acknowledge that, and acknowledge that in their strategy as well, and in their reporting. Just maybe one more question before we finish up, and Anne, it's back to you again, just with regard to the most challenging part of linking ESG and reward. Like, what would you say, broadly speaking, that is for firms?
I would say it's really picking what the metrics is and setting targets that are measurable at the end of the performance. So when you set the target, how are you going to assess that performance at the end of the performance? And also very much looking ahead to what changes could be either in the industry and the environment that would be meaningful to stakeholders. And again, to your point, Laura, and we've met it throughout the presentation, if companies have thought about the sustainability strategy, if they've metrics already in place that are being tested and tried, then I would say ideally the linking ESG to executive rewards, or indeed broader rewards, you would link in those metrics where it's most meaningful. In talking to a client recently who was putting them in for the first time, we tested them on whether it was the right metrics or not. It was around the environmental part, and given that it was their first time, they wanted to go with one that was linked to the strategy. Was it the best one? Potentially, maybe not, but it was one that was out there in the industry and being tested by their competitors as well. So they were a bit more comfortable with that. So as a first step, maybe they were more cautious, but I think the most important point is they were listening to stakeholders, they were listening to the feedback, they introduced it, and they picked a metrics that was kind of standard in the industry. Also, they looked at the weighting, and rather than maybe going, to 30% of the overall performance, which would be incredibly high and unusual, they pulled back. So I suppose it's start, be careful in your measurement, potentially know if you're taking a risk, what that risk is over time. But I think it's good that companies are having the discussion and starting, because I think it will evolve over time, and especially as more regulation comes in, as the proxy advisors give more guidance on that, it will be evolving. So very much, think today, but think long term and how it's going to be perceived.
Yeah, that's the whole spirit of it, right? To think long term. Any final comments, Melissa, Reese, Anne, before we finish up?
No, happy to take any questions or even offline.
I think we're okay. So I think we'll let the attendees go a few minutes early. I had one final observation just to make, and it was really not to lose sight of the fact that the methodologies and the metrics and the rules and regulations and the reporting and assurance and all of those things that are circling around all sectors in the context of ESG at the moment are really designed to bring about certain outcomes, and those outcomes will ideally, be embedded in firms' culture and in their purpose and in the approach to well-being, and also our approach to net zero and climate change, and that common purpose that we all have to achieve certain outcomes with all of this. So I don't want to lose sight of that. It makes things pretty tricky when you get into the technical, how are we going to do this and how are we going to measure it? But I would just advise our attendees to not lose sight of the fact that there's a goal here which is really important, and everything we do to support that goal, I think, has to be a positive thing. So with that, I might just thank Melissa, Anne and Reese for speaking today and for preparing the content which will circulate. I want to thank the Deloitte organisers behind the scenes who've helped to get us set up for the webinar today. And I just want to encourage the attendees to feel free to reach out to any of us if there's follow-up questions that you didn't want to ask today or that you think of when we finish up. Don't hesitate to get in touch. We're always delighted to hear from people. So with that, thanks very much, and I hope everybody has a great rest of their day. Thank you.
Thank you.
Thanks.